Hi, welcome to the Money Tea. Today I'll be talking about a low cost and easy way to start investing. It is called index funds. What exactly are index funds? Index funds are called passive investing because you're not picking individual stocks. What you're doing is that you're tracking the market index. You've probably heard of the S&P 500, the Dow Jones, or the Nasdaq. These are US market indices. So the S&P 500 is a market index that consolidates the price of 500 of the largest publicly traded US companies. And what the S&P 500 does is that it makes it easier to understand whether the leading US companies are gaining or losing in value. There are many other types of market indexes, such as the FTSE 100, which tracks 100 companies that are listed on the London Stock Exchange. You also have the German DAX, which tracks 30 of the major companies in Germany. Another example is the STOXX Europe 600, which tracks companies across 17 European countries. So basically, an index fund will track the performance of one of these market indexes. You can't individually invest in a market index, so what an index fund does is that it tracks the performance of one of these market indexes. And how it works is that, for example, a fund manager will look at companies that are in the S&P 500 and will take every single one of those 500 companies and put them in a separate basket, and that will be an index fund that is tracking the S&P 500. The good thing about index funds is that there are so many of them, and there's probably one for every single asset class or economic sector. They can track the performance of stocks, bonds, commodities, currencies, like the list goes on and on. Index funds are designed to be simple, like all-in-one investments. So rather than you picking individual stocks of like different companies, you are investing in all of the stocks in a market index, for example, the S&P 500 or the Dow Jones. The thinking behind index funds is not necessarily that you'll beat market indexes, but that you'll keep up with them. So consider this. Over the past 90 years, the S&P 500 has averaged an annual return of 10% a year. And if you had an index fund tracking the S&P 500, its average annual return will also probably be close to 10%. Fun fact, Warren Buffett recommends that most people should just invest in index funds. And this is because a lot of people lack the expertise that you need to invest in individual stocks. This is because to make good investments, you need to know the company's history, what the company's plans for the year are, what its financial statements are, as well as the industry the company is in. It is nearly impossible for an investor to consistently pick a stock that will beat the market. This brings me to the next point, which are the two benefits of investing in index funds. 1, lower costs, and 2, diversification. The fees that you pay on investments matter because over time they can lower your returns. In 2018, the average expense ratio for an index fund was 0.08% compared to 0.76% for an actively managed fund. This roughly works out to you paying 80 cents for every $1,000 that you invest in an index fund versus you paying $7.60 for every $1,000 that is actively managed. A second benefit of investing in index funds is diversification. Say, for example, you're invested in the financial sector and the energy sector, and it just so happens that the energy sector went down, but the financial sector went up. And now with diversification, your losses will be minimized because one is going up and one is going down, and so there's sort of like a balance, and the losses aren't as much as if you are fully invested in just the energy sector. This is great because it minimizes the amount of fluctuations with your portfolio. So now that you know what index funds are, how do you go about investing in them? So before you can start investing in index funds, make sure that you pick the right brokerage, know exactly what fees you're paying, as well as what your investing goals are. Examples of companies that offer index funds include like Charles Schwab, like Fidelity, like Vanguard, but do your research making sure that you pick a brokerage that has a long history of investing in index funds. Next, know exactly what you're investing in. Make sure that you understand what your index fund is tracking and what the particular stocks are. Like with index funds, it is common for them to have similar names, but you'll be tracking two complete opposite type of assets. You also need to know what your investment goals are. Are you investing because you're saving for a wedding, for your down payment, for college, for retirement? You need to know all of this so that you can pick the right index fund. Lastly, make sure that you understand how much in fees you are paying for your index funds. Fees can actually affect your portfolio return over the long term. Basically, you don't have to be an expert in order for you to be a good investor. Index funds can be an easy and low-cost way to beef up your portfolio. So if you don't know much about investing and don't have the time needed to do the research to pick individual stocks, consider using index funds. And that, my friends, is the tea of the day. Until next time, cheers!